If you value what we do here at GoFinance, hit subscribe and drop a comment, even just GoFinance. That simple action helps more than you realize. Mark here. And if you were watching markets today, you probably felt that move before you even understood it. We're going to break down the flash crash you just witnessed. We're going to look at the rumor that started circulating about a government mint potentially pausing silver sales. We're going to talk about why the gold to silver ratio actually matters. And we're going to examine this pricing gap that keeps showing up between Asian markets and US markets. But there are two specific reasons you need to stay until the end. First, I'm going to walk you through how someone I know handled buying during this chaos. Not emotionally, not impulsively, with a framework that kept them from turning this into a casino bet. And I'm going to show you exactly how that worked. Second, I'm going to tell you what I think actually caused this, why the official explanations are mostly noise, and why this isn't just about metals or crypto or stocks. It's about the plumbing underneath everything. That's where most people either get it or they keep getting blindsided. Check the description when you're done. I put links there for membership and additional analysis, so you don't have to hunt for updates. Okay, let's talk about what happened. A post went viral claiming this was once-in-a-decade behavior. The numbers were dramatic. Within an hour, trillions in paper value got erased across multiple assets. Gold dropped sharply. Silver dropped harder. Major indexes slid. Crypto bled. Whether you care about those exact numbers or not, here's what your eyes saw. Everything falling at once. And here's something you need to understand. When assets fall together like that, it's not millions of people all deciding the same thing. It's machinery, automated systems, forced selling triggered by risk limits. And understanding why that happens matters way more than just watching candles move. Now, right as everyone was reacting, another post started spreading. A claim that a major government mint would stop selling silver products within 24 hours. No mint named, no official statement. Just a trust me vibe. Do I believe every rumor online? No, you shouldn't either. But I pay attention to rumors like this for one reason. They don't have to be true to move markets. They just have to be believed long enough to trigger reactions. So keep that in mind, not as fact, but as a potential catalyst. Because if physical supply tightens while paper markets are freaking out, you get a bad combination. Higher premiums, delayed deliveries, people overpaying at the worst possible time. And if you're new here, let me clarify something. Buying physical metal is completely different from trading a ticker on your phone. When you buy physical, you're dealing with shipping, verification, inventory, real-world friction. That's why physical can stay tight even when paper prices are having a meltdown. Now, another angle today was the crisis comparison game. You've seen this. Someone posts a chart. In the financial crisis, gold did this. During the pandemic, it did that. And look at this move now. Something massive is coming. Here's my take. Yes, big gold moves show up around big trust events, banking stress, policy shifts, currency fears. But the mistake is thinking the move predicts one specific thing with certainty. Markets don't work like fortune cookies. Sometimes the move is the event. Sometimes it's front-running something. And sometimes it's just money looking for a safer corner. And that brings us to the phrase everyone's talking about today, forced cash settlement. Some people are saying when demand for physical delivery overwhelms vault supply, exchanges can declare an emergency and cash settle contracts instead of delivering metal. Let me put that in plain English. If you bought a contract expecting metal, and they tell you, here's cash instead and we're setting the price, you didn't get what you paid for. The promise changed. Does that happen tomorrow? I'm not predicting dates, but you should understand the incentive structure. If too many people demand delivery at once, the system's priority isn't making you happy. It's keeping itself alive. Here's the counterpoint though. This matters. Cash settlement isn't always the disaster people make it sound like. It can work as a pressure valve. It can create legal fights. And it can backfire by destroying trust and pushing people into physical ownership outside the paper system. So if you're waiting for some dramatic collapse moment on camera, you might miss the real story. The slow drift of confidence away from paper and toward physical. That drift doesn't trend on social media, but it changes everything over time. And speaking of social media, we saw the usual pattern today. A well-known commentator showed up early, saying gold was unwinding and silver looked overvalued. Markets bounced, and people immediately started joking. If he says sell, I buy. You know the routine. Here's the reality. Whether he's right or wrong doesn't matter as much as understanding what role these voices play. They make you feel like the move was obvious after it happened. They turn uncertainty into story, and stories are powerful because they stop you from doing the math. Now, the what caused it conversation, this is where it gets interesting. You'll hear 1,000 explanations. One entity dumped crypto, a report leaked, a headline, a speech. A hedge fund blew up. A broker tightened margin, an options dealer hedged. Most of that is noise. The most likely core driver is this. Automated systems reacting to the same triggers at the same time. Here's how it works. A keyword hits. A volatility threshold tags. Liquidity thins. One algo sells. That moves price. Another algo sees that and sells. A third hits risk limits and has to cut. Suddenly, a small push becomes an avalanche. And here's what nobody talks about. These systems don't care what the asset is. They care what the model says. If the model says reduce risk, it sells gold, silver, stocks, crypto, all in one sequence. That's why it feels like everything got punched at once. I talked to someone I know who's been managing risk for decades. I asked, "What's your cleanest explanation?" He said, "People are hunting for one headline, but the real cause is feedback loops. One machine sells, triggers another, and suddenly the market's on autopilot." Then he said something that stuck with me. The most dangerous thing on days like this is the story you tell yourself after. Because if you blame the wrong thing, you position wrong for the next move. That's critical. The next move is already being set up while people argue about the last one. Now, remember the talk about AI data centers being automatic economic wins? My contact laughed. He said, "Nobody wants to admit most of these projects don't have clear returns yet. They're betting on future demand, and the grid is the bottleneck. If power costs spike, margins get ugly fast." He's not wrong. Recent winter grid stress showed how tight things can get. Data center heavy regions can see electricity prices jump hard during peak events. So when you hear AI build out helps the economy, also hear it's pulling forward massive spending. And someone has to pay for it. When financing gets tight, you get volatility. Now, before we talk about the purchase approach, let me kill one more myth from the comments today. People were saying, this must be force majeure. Insurance covers it. That's not how it works. Force majeure is for things genuinely beyond human control. Hurricanes, earthquakes, wars shutting down shipping, a shortage from too many paper claims chasing too little metal. That's not an act of God. That's design. And if a system tried to call that force majeure, you'd see lawyers fighting for years. Insurers would do everything to avoid paying. That's not drama. That's contract reality. Okay, let's focus on what you can actually control. Because doom scrolling doesn't pay your bills. Someone I know called me last night. You could hear it in his voice, excited, nervous, trying not to miss something. He wanted to buy a big chunk of silver immediately, saw the chart moving, didn't want to miss the next leg. He said something like, "If it hits the next number, I'll flip it." I had to stop that immediately, because if you're buying in panic and selling in panic, the market eats you. You're not investing, you're feeding the machine. So here's how I walked him through it. You can apply this whether you're buying metals, stocks, whatever. Step 1, understand quoted price versus actual cost. Most people see spot and think that's what they'll pay. It's not. There's screen price, then there's your all-in cost. When you buy physical, you pay a premium above spot. That premium can be small when things are calm. It can explode when everyone rushes in at once. Premiums are the market saying, we can't turn your clicks into bars instantly. So I told him, before buying anything, spend time watching premiums. Watch how they widen when prices rip. Watch how they move when fear hits. Get familiar with the rhythm. Step 2, never commit everything on your first click. If you're right, you still win. If you're wrong, you still have ammo. This one rule saves people from the "I bought the top and now I hate this forever" trap. Step 3, decide your purpose before you buy. Are you buying physical long term? Then be ready to hold through ugly weeks. Buying to trade? Then don't pretend it's forever when the chart goes red. That's how people get stuck. This morning he called again, even more intense. Price moved higher overnight. He was convinced it could only go up, wanted to slam the buy button for a big amount. I told him, you don't buy parabolic candles, you buy pullbacks. And if you can't handle pullbacks, you're sizing too big. We agreed. Cut the first buy in half. Not because I'm bearish, because discipline beats ego every time. Then the market did what it did. The drop hit. I'm not going to pretend I predicted a flash crash. Nobody predicts those consistently. What you can do is prepare. When price started falling hard, I told him, sit tight. Don't catch a falling knife. We watched for stabilization. Not the exact bottom. Stabilization. Here's what that looks like. The drop slows. Price starts chopping. Bounces stop making instant new lows. It's messy, never feels safe, but it's better than chasing. When we saw that, we picked a level meaningfully lower than his emotional entry, but not so low he'd freeze and do nothing. Important. The perfect price is worthless if you never act. He bought smaller first. Then we planned a second buy only if price dipped again. If price ran, we'd already be in. If it dipped, we'd average. That's how you avoid all in at the top. Here's what helped him sleep. We chose a product type with lower premiums per ounce. Bigger bars often mean lower premium, less flexible to sell in chunks later. But that trade-off is real. And before anyone asks where to buy, I don't care if it's a marketplace, local shop, online dealer. I care about 3 things. Is the metal real? Will it show up? If something goes wrong, can you dispute and get funds back? That's it. Loyalty doesn't protect money, process does. Let me give you a framework for the next time a mint shutdown rumor hits, because this is where bad decisions breed. First, separate spot move from supply move. Spot move is price changing on screens. Supply move is when products vanish, lead times extend, premiums jump even if spot stays flat. If you only see spot volatility, that's trading. If inventory disappears, that's supply chain. Second, watch the premium curve. Not just one premium. Coins, small bars, big bars. They all behave differently. When panic buying hits, smallest items get cleaned out first. Premiums explode. That doesn't mean silver is worth more magically. It means convenience is getting priced in. Third, don't let scarcity force you into a sketchy counterparty. When people get emotional, they'll buy from anyone with flashy listings and fake reviews. Your goal is boring reliability. If you can't verify track record or dispute process, you're gambling with delivery. Fourth, if you're building long-term, think about exit flexibility now. Big bar, cheaper per ounce, harder to sell in pieces. Small pieces, more flexible. You pay for that. No perfect choice, only what matches your situation. Fifth, remember this. The point of physical is reducing reliance on promises. That's why I'm more interested in real behavior. Premiums, inventories, delivery times, than dramatic posts. One more thing. A lot of money-moving markets doesn't care about metal. It cares about liquidity and collateral. Big capital still holds government bonds as core collateral, even while complaining about debt publicly. That tension is why markets look calm for weeks, then snap in an hour. You'll see it again. When it happens, people with a plan treat it like opportunity. People without treat it like crisis. Now the international pricing angle. This is where silver gets interesting. There's been this gap between Asian silver pricing and US markets, sometimes small, sometimes big. When it grows, it's telling you something. Physical demand and local supply can detach from paper pricing. Paper isn't irrelevant, but it's a reference, not the whole truth. Why would foreigners hunt US silver? Arbitrage. If one region prices higher, someone buys cheaper and sells expensive, not conspiracy. Capitalism. Now, the gold to silver ratio. I want you to actually understand why this matters, not just memorize numbers. The ratio is how many ounces of silver equal 1 ounce of gold. Historically, it's swung wildly, modern decades, usually mid-60s. But it spikes in panic, compresses during silver runs. Pandemic panic, hit 125. Market screaming, I trust gold more than everything. 2011 silver peak, low 30s. Silver was the crowded trade. Recently, high 40s to 50. Different regime entirely. And here's what matters. When the ratio moves, it's not just about metals. It's about fear, liquidity, and which side is crowded. Let me close with this. Next video, I'm mapping out 3 signals that usually show up before the next wave of volatility. Signals you can spot without expensive tools. If you recognize those, you don't have to guess tops or bottoms. You just avoid the costly mistakes. But for now, apply this framework. Decide max position size. Decide entry approach. Write it down. Markets only feel fair when you're prepared before emotions take over. Even after buying the dip, his break-even wasn't chart price. It was chart price plus premium. That's what beginners miss. If you buy physical, think in 2 prices, market price and all-in cost. When you get that, you stop obsessing over every dollar move. You focus on actual cost basis. If you're finding success, share it in comments. Real experience helps others. This is Mark from GoFinance. Subscribe for market structure analysis. See you in the next one.